Good day, everyone, and welcome to today's webinar hosted by Pinnacle Partners. We're thrilled you've joined us today. We're going to dive deep into and provide for you a 2025 market outlook on build to rent BTR. We're going to talk about the Southeast region and why it's prime for investment and fast growth. And we're going to talk about the opportunity zone legislation, which seems poised to be extended and expanded. And once again, greetings, everyone. I'm Jeff Feinstein, founder, co-founder, and managing partner of Pinnacle Partners. At Pinnacle, we source the highest quality OZ real estate projects. We have been doing so since the legislation was enacted in 2018. And today we're going to preview our actionable fund in partnership with Trilogy Investment Company. We have curated 3 projects in 3 markets, and we will ultimately deliver 496 townhomes in Huntsville, Charlotte, and Decatur. That's Huntsville, Alabama, Decatur, Georgia, and Augusta, Georgia. And we're going to talk about the fundamentals of each market, and we're going to do so with our partner, our co-GP partner, Trilogy. And so I think we will deliver to you today. I know your time is valuable, but today we want to deliver actionable investment insight. You can take a point of view, number one, on build to rent, which we think is the most attractive asset class in the entire real estate market as an investment vehicle. And 2, the benefits of opportunity zone investing, the tax incentives associated with that, and then the fundamentals that we use to underwrite on an institutional basis, the performance and the execution that will deliver an attractive return profile. So first, the disclaimers, the obligatory disclaimers. And so the panel we have today really provides expertise in the various topics we will pursue. So David Baer will speak to the BTR market at large, why Trilogy, who's been exclusively delivering and executing on BTR since their founding, has high conviction on the asset class. Austin will deliver the market fundamentals, market by market, very specific to our fund, the curated fund of 3 projects. Jill Holman, our Chief Investment Officer, also an expert in the Opportunity Zone legislation, will discuss, one, our underwriting and our point of view on the same markets, as well as an update, a real-time update on the new administration's intention to expand and extend the OZ legislation. So one more time, the agenda before you, a market outlook on build to rent at the macro, the specific market overview of the 3 submarkets we're investing in with this actionable fund, which is taking investment now, and then the latest on the OZ program. One more time to introduce ourselves formally, Pinnacle Partners. Many of you, some of you, I should say, are current investors, and you're here today for a real-time update on your investment, which we appreciate. Others are prospective investors. You've been evaluating this particular fund, and again, we hope to give you the actionable investment insights to take a point of view. As you may recall, we are exclusively dedicated to executing on the Opportunity Zone legislation since it was enacted in 2018. We are now a registered investment advisor with over 300 million of gains invested. We've capitalized close to $1 billion of projects, the most attractive and highest quality OZ projects across the country. That's a total of 17 projects. And Novogradac has rated us in the top 5% of all funds. We think we're very good at sourcing. We're very good at deriving partnerships, and today we're profiling, putting the spotlight on Trilogy, and ultimately we're very good at being a steward of our investors' trust and investment. So the fund that is available today is a $60 million curated fund of 3 projects, as mentioned. We've taken a lot of risk off the table by already investing and funding pre-development, land acquisition, and now in the process of going vertical in each of the 3 markets, and we'll discuss that in far greater detail. So at the end of this session, number 1, all questions, please put them to the chat, and we'll have a Q&A session. And number 2, if you want to look at any specific diligence information we share today, our data room is available to you if you don't already have access to it. So with that as a preamble, David, why don't you introduce yourself in Trilogy and then speak to the BTR market?
Thanks, Jeff. Welcome, everybody. Appreciate the opportunity to meet with everybody today. David Baer, Executive Vice President of Investments and Structured Credit at Trilogy Investment Company. We are a Alpharetta, Georgia-based residential housing development company with a focus on build-to-rent. Sharing Jeff's sentiment, we believe that build-to-rent is really, in our minds, kind of the single greatest opportunity in terms of asset class of real estate today. It's established enough where there's a lot of institutional investors that are coming into the space, and we'll detail that on some of these slides. But it's also emerging where we just see a lot of opportunities just across the Southeast and across the country, more so than in traditional multifamily. And then I think pairing that on opportunity zone investment is really interesting in that there's a lot of growth in these markets in the Southeast. And so you're coming into a market that's established, that has, clear demand drivers in them. But given the nature of the investment, we have the ability to really watch the long-term rent appreciation happen over time. And so just to give a little bit more insight into Trilogy, about 30 professionals, completely vertically integrated. We're based in the Southeast. We do everything from site selection, entitlement, through to site work development, horizontal development. And then we actually just announced this week, we actually acquired an Atlanta-based home building company that we've rebranded Rev Homes that will actually perform the vertical construction for our build-to-rent projects. And so we're able to control costs, really value engineer, and really take our partners and investors all the way through the cycle, from beginning to end, not having to rely on other third parties. We primarily source deals in-house. We have a full acquisition team, and we focus on both OZ and non-OZ sites. These happen to be opportunity zone sites, but these are all markets that we would invest in regardless of the nature of being in an opportunity zone. And just to kind of touch on, built for rent and kind of why we believe in it, why we're bullish on it. Obviously, there's a massive housing shortage. A lot of that is in these high growth markets throughout the Sun Belt. You're seeing the cost to purchase homes has increased substantially. Wages haven't really caught up with that. And then in addition to that, kind of on the flip side, is the median renter age has increased. And what we're seeing in build to rent actually is extremely high household incomes in our communities and across the nation in general. Your median renter age has increased by almost 10 years, really since COVID. And so what you're seeing actually is a lot of renters by choice who are choosing to either relocate for a job or retirement and would prefer to not necessarily put equity back into a home, but to have the same product, if you will, for rent. And so what we're seeing are rents that are, anywhere from across the country, $2,000 to $4,000, just as a general. And most of these homes are $350,000 to $600,000 comparable homes. So really interesting opportunity from a rental standpoint. It attracts a demographic that I think has been underserved. And we're seeing that as a response in the market with the amount of interest it has garnered through institutional investors.
One other thing just to add to that, David, is on the trend of the shifting demographics is the first time home buyer age in 2024 was 38 years old, which is up 5 years from 33 in 2020. And the first parent age is up from 28 from 25 in 2001. So there's just a general trend of these major life milestones happening later in life, opening up a gap in between apartments and first-time home buyers that's really created this demand for build-to-rent.
Yeah, thank you, Austin. It's a great point. This slide, what's interesting is it kind of highlights, what we view as sort of the three food groups as far as rental product. You have your conventional multifamily apartments. Generally speaking, most of that is 1 to 2 bedrooms. Historically, if you were going to rent an individual home, you would either have rent that from an owner, or there's a lot of institutional investors that own thousands, if not hundreds of thousands of individual homes. We call those scattered. So they're not part of a rental community, but it's a home that's for rent. And so what's interesting there is that generally that could be a new home, that could be an older home, and you don't have the benefits that a lot of apartment living offers. And so meaning professionally managed, amenitized, et cetera. And so I think this chart is really interesting in that it kind of gives you touch points of build for rent really checks almost every box. And I think one of the most interesting things from a long-term hold standpoint is because we're purpose building rental communities, we're conceiving these communities as 100% rental, meaning there's no individual owners in the community. The agencies, Fannie Mae and Freddie Mac, have introduced programs where we could actually refinance after construction into an agency product over the long term. That would really create one of the most attractive financing opportunities. That does not exist in single family scattered. So when you think of single family rental, that could mean multiple things. What we're really focused on today in these opportunities is what's known as build to rent, which really is effectively an apartment community that's horizontal, that doesn't have any shared walls. It offers private outdoor space, which you don't get in an apartment necessarily, or most of the time. Plus you have dedicated parking in your unit. And so to Austin's point, in that the demographic is shifting, we're really serving, I think, multiple demographics across different age groups that really value privacy, space, outdoor space, and obviously having your parking in your unit as opposed to in a garage or surface parked.
And I'll just add one thing to that too, is that there's been renting a scattered site single family home has been a popular option for a long time. And there's been a notion of consolidation and aggregation in the industry, institutions such as Blackstone, Invitation Homes, et cetera. But the reality is that the institutions, they only own 3% of all single family rentals. So it's a very, very small margin, and it's a very fractured margin or market. So the rest of the market is owned by, mom and pop, quote unquote, owners that own 10 or less homes. And as David mentioned, that means there's no institutional property management, there's no on-site management. It's typically older homes and they often have deferred maintenance. So it really opens up an opportunity to build BTR cheaper than you can buy homes in communities that offer the same amenities as your typical apartment would.
And then generally speaking, and this kind of speaks to that housing shortage, this is both for rental and for sale, is that permitting generally has fallen, especially for rental, where interest rates, have increased. You're just seeing what was increased supply is now getting absorbed. And over the last couple of years, there's actually been a reduction in permitting. And so we feel that now is really the right time to build. Being an OZ fund, we're less focused on sort of short term and really looking at, are we selecting the right sites in the right locations and the right MSAs? But I think one of the positive things is there is projected to be considerable rent growth over the next few years. Sources like John Burns, who are experts in the space, are sort of predicting that based off the lack of supply. And so the good news is that there's a lot of really good short-term tailwinds that are kind of leading us. But over the long term, the important thing, or one of the important things to focus on, is sort of the growth of a market and kind of what is that going to look like in 7 to 10 years. Another thing that's interesting, and this kind of speaks to the stickiness of the product, is we're building generally larger units than you get in apartments. So your 3-bedroom townhome is going to be more sticky to a tenant. If you have families moving in, obviously moving every other year with kids in and out of a large in a house is not really that practical. So what build for rent experiences versus typical apartments is longer lease terms, meaning you might do a 1-year lease, but generally speaking, the occupancy of a tenant is going to be probably closer to 3 years plus, and the retention rate is much higher. And because it's a more of an emerging asset class, it's not as established as multifamily. When you have a fully amenitized community, it becomes very attractive. And generally speaking, tenants don't leave, and there's more demand to be in that community. And so when you see this chart, just across the country, you're looking at just extremely high occupancy levels across the asset class, which obviously bodes very well. And then same kind of comment, just re-emphasizing from an affordability standpoint, it's just becoming more and more unaffordable to purchase. And so the renter by choice, I think, becomes a lot more relevant. What you're also seeing in a lot of these markets that are high growth, where there's a lot of job growth, which is what we target, you have a lot of people moving in who, even if they intend to buy, may rent for a period of time while they establish themselves. And then this really just details kind of the depth of the market from an institutional standpoint. So even though we're not thinking about a sale in the short term, you're really seeing kind of every major blue chip institutional investor who has committed to this asset class. And anecdotally, we're on calls with a lot of these investors, and they're specifically raising funds, billions and billions of dollars to target this asset class specifically. And this is maybe one of three asset classes that are part of a theme in a given fund. So it's interesting in that you're just seeing some of the largest investors and managers in the world flock to the space and making very large investments into either operators or portfolios. And we're seeing a lot of these communities trade at a premium. So again, what's interesting is it's emerging enough where we really see a lot of opportunity and growth in the space, but it's established in that it's not pioneering, and you have a lot of support from the general institutional investment community.
Before we move on to Austin, Austin's going to go deep into each market. Remember, we have this actionable fund. I internally call it Fund 10 because Fund 8, the Pinnacle Fund 8, which has since closed, oversubscribed, $100 million fund, included two of four projects sponsored by Trilogy. We joined forces, we executed in Fund 8, and a particular project in Charlotte is really the template, the blueprint, or the pattern we intend to match here, which formed the genesis of this fund. That is townhome project in Noda. Now I think we're eclipsing close to 90% lease up, an outstanding demonstration of, I think, success between Trilogy and Pinnacle. This fund now is replicating the townhome product in these selected markets in the Southeast, which we think are really primed for significant growth. So that's now where Austin will take us very deep into the specific markets. That is Huntsville, Decatur, and Augusta.
Thanks, Chip. And you'll notice in this fund, but in general, Trilogy's strategy is primarily focused around the Southeast in our investments, and for good reason. The Southeast has been outpacing the greater United States in most growth factors, including population growth, labor force, job growth, and GDP growth. So obviously this is not a new investment thesis, but the fundamentals of the Southeast and why we're invested there are very clear. So Decatur, Georgia is the first project in the fund. It's 45 townhomes just outside of Midtown and downtown Atlanta. Very, very high growing area. You'll see it's well located, about a 30-minute drive or less, depending on traffic, from Midtown and downtown Atlanta. You're about 15 minutes from Emory University, about 10 minutes to downtown Decatur. Been an extremely high growth gentrifying area, and where it is located on the 285 freeway gives you accessibility. You're within a 15 to 30-minute drive from essentially every major employment area in the Atlanta metro. So Atlanta is it's old news in terms of its growth story, but just to reiterate a little bit, it's home to Delta Airlines, the Emory University, and healthcare. It has 29 Fortune 1000 company headquarters, and includes 16 Fortune 500 companies, and has continued to grow in terms of its residency for Fortune 500 companies. And a lot of that is due to Georgia having the lowest cost of business for 8 straight years. The Atlanta MSA itself has the 9th largest GDP in the nation, which is it's rivaling like Miami, Boston, some what we think of as much larger economic centers. But Atlanta has truly become the kind of the tech, finance, and business capital of the Southeast. And tech employment has grown at 20% over the national average since 2010, creating 113 billion of economic value, which equates to roughly just under a third of Atlanta's total economic value. So it's been a sneaky tech hub in the United States. And then in the submarket specifically, we've seen significant growth of household income coming in at 4.5% for 3 years in a row. So Augusta, Georgia, this is a larger project for 245 townhomes. This is obviously a much different location relative to Atlanta, a much different market. There's some extremely compelling drivers here on why we are really hot on Augusta, and we're very, very well located here as well. About 15 minutes from downtown Augusta, about 8 minutes or less from an entrance to Fort Eisenhower, which I'll touch on in a moment and why that's so important. And then about 8 to 10 minute drive to the Doctors Hospital of Augusta medical facility and center, which is it's a massive medical campus. So Augusta has a very interesting market driver and future ahead of it that I think bodes extremely well for an opportunity zone fund. So Fort Eisenhower was renamed a year ago from Fort Gordon. It's now the U.S. Cyber Command headquarters. It was one of 8 facilities across the country. The U.S. Cyber Command has now consolidated all 8 facilities into Fort Eisenhower. With that, they have a $2 billion improvement plan that they're going to implement over the next decade. And that's going to run a total annual economic impact of $2.4 billion. And that's public and private investment. And with the leaps and bounds that we're making in AI and the leaps and bounds that have been made in the tech industry over the past decade, one of the pieces of that tech industry as a defense against the potential use of technology as a weapon is cybersecurity. So them relocating and consolidating their Cyber Command headquarters here, we think will have a massive private industry impact into the Augusta market. So right now, Fort Eisenhower employs 31,000 employees. Between just about a third of those are military and 2/3 are civilian employees. But they generally the U.S. military uses a ratio of 2 to 1, meaning for every 1 job on base, it generally creates 2 jobs conservatively into the community. So Fort Eisenhower itself, as it stands, should create an annual job impact of 64,000 of community job creation. But I think that's really going to increase as they build out their cyber command center, and then there's continued private investment into the cybersecurity space there. Doctors Hospital of Augusta is one of the best hospitals in the nation. That's one that's just up the road. It's the 23rd ranked teaching hospital in the nation, is consistently ranked in the top 100 hospitals in the nation as well. So, and Augusta in general is just seeing significant investment from across the country into the Augusta MSA, seeing $6 billion of economic investment over the last 7 years, and that trend is continued to grow. And it also has the Masters tournament, so that's not a bad second thing either. So, and then Huntsville, Alabama, it's a 172 townhomes. Again, very well located, 15 minutes from downtown Huntsville, and an excellent school district as well. So Huntsville is affably known as the Rocket City. In fact, their minor league baseball team is known as the Rocket City Trash Pandas, but they were named the Rocket City because of its history of aerospace and defense innovation. So there's 3 very key pieces to that. Redstone Arsenal being the first. It's the U.S. Army's Center for Missile and Rocket Programs, and it's been there since the 1950s. That has about 50,000 civilian and contract employees. Cummings Research Park, it's the 2nd largest research park in the nation, and I think the 5th largest in the entire world. And that has more than 26,000 employees and has obviously household names such as Lockheed Martin, Northrop Grumman, and IBM. And then Huntsville is also home to NASA's Marshall Space Flight Center, which also has 7,000 employees. And all the growth in Huntsville, for as much as it's grown, not just because it's a great place to live, but it's grown because the job growth has just been so substantial, with 3% annual job growth over the last 5 years and a 2% unemployment rate. It's also very extremely well educated market with the highest PhD per capita anywhere in the nation.
Excellent. Well, thank you, Austin and David, for the overview. Build to rent and the specific markets we intend to invest in. We are intending to give you, once again, actionable investment insight. So we think that we have a very compelling product in the right growing markets. And we also explain the thesis for build to rent, how the renter profile and persona is very attractive. The return on cost to build is very attractive. As a result, this fund is projected to return 15% IRR before tax benefits. The tax benefits, when imputed, could add an additional 400 to 600 basis points. This is the most compelling tax incentive ever enacted by Treasury. Our CIO, Jill, will now take us through both, one, Jill, maybe commentary as to why we chose to underwrite these markets, select these markets, and now form the fund around these 3 markets in partnership with Trilogy. And then I know you've been very active in communicating with Senator Tim Scott's office, so I think you've got the real-time on the possibility of extensions and expansion of the Opportunity Zone legislation.
Great. Thanks, Jeff. So we'd like to just make really 3 points first before jumping into that to discussion about opportunity zones. Point one is really why these locations, and something at Pinnacle Partners where we focus heavily on what are the major economic drivers in the market. And I think that's a point that really Austin, I think, hit home with his discussion, is you have in the Atlanta market, you have significant Fortune 100 company locations, excellent college towns. So you have just significant economic drivers of why Atlanta, why Decatur. Secondly, with Augusta, you have Fort Eisenhower, 31,000 employees. We can all of us really see significant investment being done in cybersecurity. We know why it's important. And so that's a big economic driver for our project in Augusta. And then thirdly, you have the story of Huntsville. Have been looking at that market, investing in that market for myself personally for over 5 years. And you have, with the Redstone Arsenal, 38,000 employees, with Cummings Research Park, Jeff Bezos's rocket companies headquartered there as another example, over 20,000 employees. So just a story of a growing economy. So that's the first point. The second is, lots of projects and lots of funds talk about their projects being permit ready and, or shovel ready. And what I'd like to just say is, these projects are truly shovel and permit ready. These projects are either capitalized or imminently with debt, line of sight into debt. And so these are truly strong locations, strong markets, shovel ready projects. And just wanted to make a point, and this is something that I encourage you to check out our war room, follow up with Jeff and his team. So this is a fund that we're co-sponsoring with Trilogy. And it's something where we are, in terms of our fee load and the fees that our investors would pay, we've moved to just one layer of fees that we're sharing in a co-sponsorship function with Trilogy. And so as a result, we're able to pass those savings on to our investors. And it's a point that we'd really love to talk with you more about how it works, but just want to point it out is that this is a very unique offering to have just one layer of fees plus have 3 identified deals. So not a blind fund, 3 identified deals that are shovel ready in strong locations. And then, moving into opportunity zones. So this, all of these projects, this fund would qualify for the opportunity zone benefits. And as we look in the future, the questions, what do opportunity zones, what does this tax program look like in this new administration? And so fortunately, as you may know, that President Trump on the campaign trail made opportunity zones a key part of his campaigning. He even mentioned it at his acceptance for the Republican nomination, gave a shout out to opportunity zones. And so what I'd first start out with is we have allies, opportunity zone allies in key roles in the administration and in Congress. And so I'll just mention those allies and then talk about why that's important. And so that those allies, just for example, include Senator Tim Scott, who's now chair on the Senate side of the Senate Banking Committee. You have Congressman Smith from Missouri, who is chair of the Ways and Means Committee. And you now have the former executive director of the White House Council on Opportunity and Revitalization, Scott Turner. He is now the new HUD secretary. So he was in the role of advocating and coordinating the government efforts around Opportunity Zone in the past Trump administration. So now he's Secretary Turner and playing a key role. We have Opportunity Zone allies really throughout government, whether that's in Treasury, all the way to, education, ag, all through the government. And so it really paints a very favorable story as it relates to the administration. And then also you look at Congress and having key Opportunity Zone allies in Congress. What I also point out is some folks may not be aware of this, but in its DNA, the OZ tax incentive was bipartisan. So it was bipartisan in the House, it was bipartisan in the Senate. And interestingly, in 2020, Joe Biden made opportunity zones a key part of his economic plan, and he kept opportunity zones and some of the provisions that have been passed in the White House Council in place. My point is that this isn't just about, Republican and a new administration and having key people in Congress. It's also something on the other side of the aisle. There are key Democratic allies that see the positive that has taken place. So why it's important is there's three potential avenues for changes to this tax incentive. The first is a tax bill. And what you may have seen this week is President Trump came out in support of one bill. So there was discussion on the Senate side of having a tax bill plus a bill that included everything else, border security, energy. So he's in support of one bill. And what we're facing is the Tax Cut and Jobs Act in 2017, which Opportunity Zones was a part. Key provisions of it are expiring, as well as the Opportunity Zone tax incentive is expiring for new investments. So if you have an investment you've already made, you're fine. But if you would like to make an investment, you have until the end of 2026, tax year 2026, to make an investment. And so it requires an act of Congress to renew. And that's something that we can talk about what that might look like. And so that's why it's important to have key allies in Congress. There's also opportunities with a new administration, with new people serving that are Opportunity Zone allies. There's opportunities for the regulations to change. And so there's some technical aspects of the regulations that could improve. It can make your tax attorneys and your accountants very happy to just have this kind of function and fit together better. So there's opportunities for that. And there's also an opportunity for an executive order. In the 2016 White House, Trump set up and passed an executive order that established this White House Council essentially for opportunity zones to really bring together all of government in support of opportunity zones. So there's another chance for an executive order. Will that happen? I don't know, but it could be very, very interesting to see what that might look like. As I mentioned, for a potential extension, there's also conversations and advocates lobbying and speaking about, let's not just extend this, let's make this permanent, where it really functions as almost like a rolling program. So and I'll get into some of the suggestions from Novogradac, a tax and accounting firm. They have a working group that they've submitted a letter to Treasury and a letter to key stakeholders to advocate for changes to the program that Congress can take up. And one thing that we've really seen at Pinnacle, as I'm sure other folks may have experienced, is that interest in opportunity zones really tracks and correlates with the equities market. So when we see our NVIDIA stock going up or Apple stock hitting a high, folks decide to sell and put some investments into opportunity zones. And so as we have the stock market returning and starting to return and increase, we also expect there to be more interest in the tax incentive. And in terms of just the impact to date, the data from the government, the latest data the government has is the end of 2022. And there's been over close to 85 billion in equity invested with the tax incentive. And as you know, there's 2+ years beyond that. So, we can extrapolate what beyond the 85 billion in equity may be invested. And I would suggest that 85 billion is, if not at 100, it's approaching 100 billion in equity. And so to touch on Novogradac's Opportunity Zone working group letter, these are several recommendations that they made and other folks advocating for changes in legislation and for changes for this tax incentive. So, think about this as maybe an Opportunity Zones 2.0. As I mentioned, extending the deadline or making this tax incentive permanent. The other is enhancing reporting to make the data more transparent. So where these investments are taking place, helping the policymakers really understand how this money and where this money is being spent. There's limited reporting that's being done to really people report that they made an investment and these funds say, how much they invested and what census tract or where they invested. But beyond that, there's not really a lot of data. And so a lot of the analysis that's been done is really extrapolating that information and doing analysis around public, information that the request from the IRS. So just having this available that policymakers can get real time will really help with tweaking or improving this tax incentive. As we know, or maybe you're not quite familiar, but right now, a fund cannot invest in another fund. And if we enable a fund of funds model, this will really help expedite and also, I think, help expedite the aggregating of capital. And I think it would also open it up to more investors. And so investors that might want to invest with their capital gains, but might not have a place to invest because the funds have higher minimums. So this could help with that. One of the concerns is a lot of these investments have taken place in urban or suburban areas and really trying to, with an OZ 2.0, having and promoting more investments in rural communities. And in fact, that's what Chairman Smith had introduced in a previous Congress, a bill to expand opportunity zones in rural communities. And so there's really a strong desire to make this work better in rural communities, and also to really have this work better for our small businesses and operating businesses. And just another point I'd make about recommendations is to allow non-capital gain investments to receive tax benefits. And this was originally conceived of notion that there's billions or trillions invested in equities and, locked up in the market, and incentivizing that capital to move out of that market and into areas in need. So really attracting that capital into these underserved areas. But as a result, you just have really these intermittent types of capitals that are available, and it makes really bringing the money, which is the policy goal, bringing capital to these areas, it becomes very challenging. And so why not make this eligible for non-capital gain dollars if the goal is to bring private capital, and not the government capital, but private capital to areas that these governors have designated as, the most distressed and urgent areas in need of capital. And so that's the idea behind extending that. In addition, as I mentioned, there's regulatory recommendations. So my hope would be within the administration that the IRS takes up some of these regulatory questions and just makes it work and fit and answer some of these open questions that our tax attorneys and our accountants have, and just make it maybe it's cheaper for us to invest and to execute.
So thank you, Jill.
Yeah.
I should note Jill is part of a think tank that is also contributing text to the proposed legislation. And we stand ready to answer any and all questions. I wanted to make a quick comment about the 180-day rule as it applies to OZ investing. So you realize a capital gain, short or long term, from any source. That could be NVIDIA stock, or it could be real estate sale, crypto sale, collectible, even a business sale, all qualify for OZ incentives and tax treatment. You have 180 days from the realization of the gain to invest and qualify for those incentives. This fund is actionable, as we've been discussing. So there is an opportunity still to mitigate 2024 tax. And many of our investors are currently inventorying their gains from the prior years. K1s come late, as most of us know, and sometimes surprised with maybe the hedge fund that realized Palantir gains or other such gains, and now have the ability to invest that capital gain for OZ investment and the diversification that comes with the real estate. So we stand by. We've recently retained a tax advisor to assist any one of our investors with their tax questions. We're not dispensing tax advice per se, but we're looking at the qualification. In addition, if you have a partnership K1, which this hedge fund example probably most likely is delivered on a partnership K1, you may have even more time beyond the 180 days. So check with us to determine if your gain qualifies for OZ tax treatment. Looking at the Q&A here, we've got just a few minutes, but David, I'm going to put this to you. You referred to BTR as horizontal multifamily.
Mm-hmm.
So do we expect that all the typical financing, Freddie, Fannie, apply to this asset type? Do we expect that the same institutional appetite exists for the acquisition, the ultimate exit and sale to insurance company, pension fund, etc., for a portfolio like ours 10 years hence?
Yeah, absolutely. So I think, again, that's one of the attractive things about BTR versus scattered single family is that it does qualify for both agency financing, and then a lot of the insurance companies and even some private debt funds are creating product that's competitive to agency. So what's nice is you have a plethora of options from a long-term refinance scenario. So typically we would take on construction debt to build the project and then look to refinance at or close to stabilization through one of those products. So that's one of the, I think, the differentiators and a really a positive attribute of BTR is that it's viewed and valued like a multifamily from an income standpoint. So an institutional investor, to your second question, Jeff, is institutional investors really value these as really kind of the sum of the parts and not looking at necessarily as an individual kind of value of a home, but really looking at the net income and applying a cap rate to it. And we're seeing BTR communities trade at very similar cap rates to what multifamily would trade for. And so there is increased demand, as I mentioned earlier, from institutional investors, specifically highlighting BTR as a theme within new funds that they're raising. We're seeing both portfolio trades, platform trades. In the case of Tricon with Blackstone, where they actually acquired tens of thousands of homes in addition to that platform itself. And so, this actually lends itself where there's a lot of flexibility where the homes could be theoretically sold individually, although unlikely. The communities could be sold individually, depending on kind of market timing, or this fund could actually be sold to an institutional investor at scale as a package of three. So a lot of flex. That's all to say that a lot of flexibility and already proven out that we have sort of those levers to pull in the future.
And the optionality to sell an individual plat or an individual community gives us a lot of flexibility. Austin, a question to you. You spoke about the average age of the home buyer now has increased 5 years, I believe, since 2020. Trilogy does extensive renter persona analysis. So can you describe the types of renters that ultimately this product is targeted to?
Yeah, absolutely. There's three main groups that will put that in. And there's young professionals, which is, could be a couple, could be a roommate situation, whether, and for a couple, whether married or unmarried, typically it's a graduation from the apartment living into something else. I mean, personally, I'll just say anecdotally, my girlfriend and I just put in an application to move to a townhome. We've been living in an apartment for however many years. We're ready to be out of that and move into a townhome. So I actually myself am in, kind of the section one of the main renter demographic, the renter persona. The second is the up and coming family. So in this case, this could be either one of two things. They're either forced out of, typically a married couple, forced out of an apartment, or again, kind of in the moving up role for different reasons. It's typically they want to start a family. And so they're looking for something, but they're not yet ready to buy. So they're looking for a home that they can rent, typically in a good school district, that's going to have access to, grocery stores, schools, and relatively close to their place of employment. And then the third main cohort is the empty nester. There's several, probably a solid portion, 25 to 30% of BTR communities out there. They're not age restricted, but they're quote unquote age targeted. So they'll have, a primary bedroom down, floor plans, and it's for those who are, retirees. They're on a fixed income. They have a 3,000 square foot house somewhere in the Northeast, and they said, you know what, I want to move to coastal Carolina or coastal Georgia, and I want a maintenance-free lock and leave situation to live in. And so that's kind of the third main cohort. And then I guess there is a fourth that we've been seeing increasingly, which is those of sold their home and are waiting to buy a new home, whether they're waiting for the market to settle down or they are waiting for a new home to be built. You'll see in many of our communities, we're very close to new for sale communities. And then the other part of that is of the transitory renter is those who, are called away from anywhere in the nation to move to Atlanta for work. They're moving from a home, and they want some time to settle in before they buy a place. They're not sure what neighborhood they want to buy in, so they'll rent a home for a time being. And so those are the four main renter personas that we see.
Thank you, Austin. And then Jill, final question. I referred to our success in the prior fund, Fund 8 in NODA. I'm going to share, this is the leasing website for the project. Jill, can you just speak to the success thus far of this project and how it kind of is replicated in Fund 10, as I call it?
Yes, so this project is in Charlotte, which I would describe as is a similar market to Atlanta in that it's fast-growing urban environment. And so this is in a location that reminds me a bit of Decatur, where it's a fast gentrifying area. These 68 townhomes are located in what's called NODA. The project's called Rev NODA Junction. And so it's walkable to the light rail system. And so this is an area that, maybe 2 years ago, you would think, whoa, there's nothing going on here. But what you find now is, our project, our 68 units and everything is coming up around us. And so it's walkable to cool new theater with a wine bar and coffee shop is just maybe block and a half away. And then you have all these other major mixed use development with significant retail is coming up. And so all of this is walkable. And we are kind of one of the missing tooth that now is filled in this, infill type. It's more of an infill type site, which is like what Decatur is. Decatur 45 units, 45 homes. This is 68 homes. And so this is something that I think we've, really worked through a lot on the operations side. We're more than 85% leased and we're approaching, getting leases. And after this call, we're jumping on our asset management call for NODA Junction. And so this idea is this sort of infill site in a hot submarket of a major urban and high growth larger market is really the thesis. And you'll see really the quality of the finishes. This was one that was a forward purchase. So we bought, we can't buy entirely completed homes. And so we bought mostly completed homes and then had them completed. And so we then acquired these over the course of a number of months and then would, work on leasing them as they were delivering. So we're excited to take this model and replicate it with these three projects that are similarly well located with significant economic drivers.
Excellent. Thank you. Well, I think that brings us to the end here. I want to thank everyone for their interest and attention. Covered a lot of ground, the thesis, the macro thesis on why BTR, how we've curated and wrapped the fund around these three actionable projects and the markets within them, why they're dynamic, growing, and suitable for investment. We gave you an update on the OZ legislation, which is very real time. We make available our data room for all this information to be disclosed, and we can jump on a call if you wish to dive into the details. So we look forward to that. Please reach out. I'm Jeff at pinnacleoz.com. Thank you once again. Have a great day.